Arvin, so the first quarter was flat in terms of the S&P, but it did see the return of volatility. So who wins in that situation? Is it the hedge funds, the traders, the bartenders? Who's the big winner?
Well, as you said, definitely the bartenders benefit. But what we'd broadly say is, as a whole, this is much harder than what we've seen in the past few years. This is no longer an environment where you just decide to be bullish everything or bearish everything. You need a lot of selection here. And again, that's what we're focused on. We're focused on managers that have a good expertise, both in terms of finding the true sources of returns, not just long across the board or short across the board. At the same time, it's also an environment where you want to be really actively trading, and that's what we're looking for as well.
And while it's the beginning of first quarter earnings season, all eyes really remain on the Fed. So are they adding to the volatility, and what can be done about it?
I mean, it does definitely seem to be the case that the Fed is not trying to add to volatility, but at the same point in time, they are trying to move more towards a normal path. And so what does that mean? Naturally, when they've stopped buying bonds and now they're reaching the point where they're actually going to raise rates, likely at some point in time this year, that does make it harder. That means things are a little less attractive in terms of U.S. equities. It might mean things are more interesting in the rest of the world. And for fixed income, it's been a trade that's been going on for a long time in terms of being bullish. And at some point in time, that changes, and that could be this year.
And that strong dollar is also good for commodities. We've seen gold plateau. We've seen oil kind of base here around $50. So what's your view on commodities going forward?
You know, again, what we'd say is we try not to have a big directional view on certain markets like commodities. Instead, what we're looking for is saying, is there volatility? Are there options? Is there the ability to generate returns? And we've seen that. Despite what happened with crude last year, where the markets roughly halved, our managers generated a lot of returns. But now, again, similarly, you can't just be short crude across the board or short gold or whatever it might be. Now you have to decide to be long one thing and short another. So again, that requires a high degree of skill set that's hard to come by.
And speaking of long and short, what about currencies? The trade out there has been for a long time, long dollar, short euro, long dollar, short yen. What are you seeing?
We are definitely seeing that it is pretty clear the U.S. is doing better than the rest of the world. So that really is good for the dollar. At the same time, a strong dollar is actually bad for growth. And so what we're seeing is that the Fed is cognizant of this. But generally, is there an opportunity to be long the dollar? Yes. But it's that same theme. Do you want to be long the dollar against everything? Absolutely not. You know, this year, we've seen the euro move a lot, decline a lot. And Japan, which was the great story of 2013 and 14, hasn't moved at all. And so again, the theme is really the specific security selection, the theme. You have to be pretty exact and get this down correctly.
And then finally, where are you with regard to emerging markets? Usually when the Federal Reserve here in the U.S. raises rates, it really causes a lot of havoc and destruction in the emerging markets. Are you wary now?
I would definitely say that we are wary. Now, on the one hand, we've already seen a lot of the emerging markets sell off, but we think there's probably still a lot more to go. What I'd say is emerging markets aren't stable right now. Either they have to get much better or much worse. Right? You can't have the highest interest rates in the world in Brazil and just leave it like that. And so what that means is there is going to be a really good opportunity to be bullish, but we're not sure it's now. You need more stability. You probably need to get close to the point in which the Fed actually starts hiking rates. And then you see where the pieces fall, and every so often there's going to be some things that are really attractive and other things you still just don't want to touch.
All right, thanks a lot, Arvin.
Thank you.
And thank you for watching The Street.